Hey everyone, and welcome to this week's On the Spot. I'm Zach Strickland here with John Paul Hampstead as always.
Hey Zach,
JP.
What's up? Happy Friday.
Happy Friday. So we've had an pretty standard week for the third week of January,
Which is bad.
which is not
the
good.
Doldrums, the harsh, the bleak midwinter.
Everything's cold and gray outside. It's cold and gray on the load boards.
It's cold and gray on the income statements.
Yeah, it's cold. It's earnings season.
Yeah.
First quarter reports the fourth quarter of last year, which again we saw some interesting results in the fourth quarter last year. Net overall, I think volumes were flat. We were roughly about 1% up year over year in terms of just straight volume.
Right,
but the majority of that came in December, whereas October, November were a little disappointing.
A little disappointing, and the rate environment was obviously down year over year from fourth quarter of 2018. So, that's right. Like what we see brokerages, grow their load counts without growing their revenue, things like that. You get a lot of that.
And the converse of that is the carriers on their end. They have higher utilization but lower rate per miles.
Yeah.
So it is an interesting environment to operate in, and a lot of people think that 2018 was like super robust throughout the year. We just kind of assign it, and in actuality, it was really soft in the fourth quarter.
Volumes sharply fell off after I want to say October.
October is the first couple of weeks of October. It was a just dramatic plummet across the board, but the environment really from about the peak around July 4th just fell sharply throughout the third and fourth quarter of 2018. So it really, when we say that it was flat, that's actually not that great because it was a degrading environment in the fourth quarter.
We did have some interesting earnings reports this week, including Covenant, Martin, Harlan Express, Union Pacific, actually. And it's sort of mixed results. I think Martin's brokerage did very well. Its intermodal struggled.
Right.
Obviously, there was a huge shift in volume from the rail to the highway after trucking spot rates started coming down. Right. Covenant kind of guided that they were going to move some assets away from solo refrigerated operations into dedicated. They're trying to kind of get away from irregular over the road, operations that are hard to consistently make money at and consistently utilize your assets at. So
the reefer segment, of course, very imbalanced networks, very one-directional. So it's much more difficult to manage that operation because you have a lot of freight coming from one section of the country to the spread out throughout the United States.
Right, and then that's always been interesting to me is how different modes have different sorts of network balances, and it has a lot to it has to do with production and consumption and economic geography. So if you think about even for dry van, which is the most commodified kind of freight, it's more different kinds of freight can go into a dry van than any other mode. You still have backhaul markets like Seattle, like Denver, Miami, places like that. With refrigerated, it's even more imbalanced because of just the simple fact that food is produced in a small amount of, small sort of set of regions or markets in the country, but it's consumed everywhere. Right. And then flatbed, of course, is even more imbalanced, and expedited even more balanced than that. So it's always interesting just to think about how carriers try to sort of strategically go after different customers and achieve balance or not, or price imbalance into their networks. But obviously, Covenant is looking for a different kind of model and a different kind of way to manage their revenue. So and they've talked about this before, but they're shifting more and more toward dedicated. Heartland, which is typically
they're always
a very disciplined carrier, right?
Top of the list in terms of earnings season.
Smaller publicly traded carrier, but usually very low operating ratio. They've acquired Millis Transfer, which was operating with a 90 plus OR, and they're still kind of working on integrating that company. And so that was one of the things they kind of blamed for their miss. But
that's crazy to me because Heartland is kind of punished for its success. They grow to the point where they have tremendous amounts of earnings that they can't simply just redistribute any other way but purchasing another company.
Yeah.
And so the integration obviously takes time. Anytime you integrate another company, it takes a while.
But I think they're known as like disciplined, thoughtful operators, and I have confidence that they'll be able to make these assets work productively.
Right.
It's just a matter of time. It might take another couple quarters. Frankly, it might take a meaningful upturn in the freight markets to really, show how that's working.
Right.
Union Pacific is interesting. The responses to their earnings have been sort of all over the map.
Well, they're up. I mean, their OR went up.
Down.
Was it down?
Year over year down.
Year over year down. Okay.
So below 60%.
Right. Okay. So anyway, I'm thinking of quarter over quarter.
Okay.
Yeah.
Okay.
Quarter over quarter, they were up a little bit, which is normal. Fourth quarter, they tend to have a lot less competition, or a lot more competition. Service is a lot more in demand during the fourth quarter.
Yeah, and you start getting bad, like in the region of the country, which includes the Rocky Mountains, you start getting sort of bad weather and things like that. And railroad volumes drop off in mid to late December, like when truckload volumes really don't.
Right.
I mean, obviously, fewer truck drivers drive during the actual holidays, but that's considered a busy, frantic time for trucks. It's actually a very dead time for railroads.
Yeah. Well, it's short haul season. You've got a lot of people.
Exactly.
They've already moved the rail. The busy season for rail is about September-ish. September, October-ish. A lot of those, the biggest lane in the country, Los Angeles to Chicago, obviously a huge influx of freight coming in from the port, and then it transfers inland, et cetera. And this year we saw an increase to the East Coast, which also is contributing to that degradation of the rail.
That's true. So Union Pacific's, I mean, it was so weird because like I was reading our coverage of it, and their net income was down more than 10% year over year. Yet they said on the earnings call that they're going to like essentially fire 3,000 people, and I believe the stock's up. So it's just like, you just wonder how long this keeps going on for.
Yeah, the OR game is a dangerous one to play. I mean, especially when you're operating at 60%. I was talking with Mike Bodendistel about this recently, and about how, you can get sucked into this trap of improving your OR constantly. But what it does is anytime that you see a significant change in the environment, you're no longer available to flex. Yeah. So you miss a lot of opportunities that way as well.
You miss a lot of opportunities, and like when I see them taking 25% of all rail cars into storage, firing all their maintenance people, like reducing the number of like facilities that can build and consolidate and deconsolidate trains and stuff like that. It's like when volumes do turn up, like their service is going to be bad.
Yeah, I think that's been the criticism for the rails over the years, is that they cut their costs so low that it degrades the service and the performance.
I mean, right now it's fine, but it's easy to achieve network fluidity in a low volume environment.
Right.
When you don't have that much volume, it's easy to keep your trains moving quickly. Your dwell times aren't as long, et cetera. But like when you take all those assets off the rails and then volumes come back, then it gets complicated. And I just wonder like how quickly they're going to be able to flex back up and react. I would assume not very.
No, it takes forever to pull those rail cars back out of storage and get them back on the train and online. And it's not much different than what we see in trucking. We used to cut, our operation in the winter, because every year, winter volumes, we knew that January would come and the winter volumes would be disappointing, to say the least. But we didn't cut all the way to the bone. You cut just enough. You hire part-time over the year. You try to make it to where you're somewhat flexible in that environment, but not necessarily to the point where when March turns back on, and hey, you never know if it's going to be a huge March or, disappointing March, but you need to be ready for that, because if you miss in March, April, and May, your whole year is off.
Yeah.
So you need to be ready to hit that upturn.
So that'll be interesting whenever sort of industrial production goes back positive, whenever intermodal volumes and sort of trade reignites. It'll be interesting to see what happens on the West Coast with the West Coast rails. Let's talk about trucking markets. outbound tender rejection still above 7%, but definitely had like about a 40 basis point move downward.
Yeah, it was probably the largest single day decline in 2.5 weeks.
Yeah, from Thursday to Friday.
Yeah.
Or Wednesday to Thursday.
Right.
So, keeping an eye on that. Volumes are off pretty much in most major markets except for Southern California, which I think we believe is related to pre-Chinese New Year, and so we're expecting that to correct once that if the sort of the lag effect from that holiday hits the coast. Anything else we should talk about right now?
I mean, the big markets across the country are all down. I mean, we're all seeing this declining volume, declining tender rejection, increasing capacity. It's the third week of January. You got to do what you got to do to get by this time of year if you're in brokerage or you're a carrier. Shippers, generally have the pick. The one thing that I will say about this time of year is that you can get caught in this mentality of just expecting capacity everywhere. That's just not the case because you have a lot of isolated environments, especially these smaller markets. When we were talking about network balances, these are these irregular markets that we see really have their moment in the sun, if you will, in terms of capacity tightening.
Right.
You have Albuquerque, which is a tiny market, blowing up on terms of capacity here this last week. Rock Island, Illinois, another smaller market. So every week there's a new market that has at least some semblance of instability because trucks are they're focused on these bigger markets. They're the safe havens for a lot of the freight.
Right. I guess the only other thing I wanted to call out is just some research the Passport Research team did this week for asset operators specifically. So we kind of looked at 3 different emerging headwinds for trucking carriers. The first one just being the fact that even though accidents are down, fatalities are down, trucking carriers by and large are safer than they've been in several years. Insurance costs continue to rise, especially as a percentage of revenue. Mm-hmm. So obviously that's caused by lower revenues partially, but we know that insurance carriers are taking price. Mm-hmm. We know that a number of players have exited the commercial vehicle insurance space, allowing people to raise rates. That's a cycle. It might take a couple more years for that to calm down.
Well, the nuclear verdicts
and the nuclear verdicts are also, scare people for that as well. The diesel fuel spreads are another interesting thing we've been doing a lot of work on, and that's basically the difference between rack or wholesale diesel prices and retail prices at the pump. Carriers of any size, 75 trucks or above, are paying fuel prices based on the rack price, but they're charging their shippers surcharges based on retail. That spread has widened to the trucking carrier's advantage to about $1.10 a gallon. We think that will come down as retail prices eventually correct downward to meet the soft commodity market. And the last thing is just falling asset values. Used truck prices are down sharply since October.
So all these things are really going to contribute to reduction of capacity at some point. Now the fuel situation is a little different, but the wholesale price has been a lot more volatile than the retail price.
Yeah, the wholesale price moves according to the way the crude oil contracts are traded, how domestic distillate inventories are reported on a weekly basis. So it jumps around a lot. That's been kind of interesting. I mean, I think the real thing is that all 3 of these headwinds are kind of cyclical, and it's just something that people have to manage through. They'll get better, but the business environment is not by any means at the point of improving right now for asset operators.
Right. Well, so it is the quiet time of year, but things will change as they always do. That'll do it for this week's On the Spot. Thank you so much, JP.
Thanks, Zach.
And we'll see you next week.